Hello and welcome to the Green Voice Podcast. I'm your host, Grant Ervin from S&B USA. We're here to get all the dirt on sustainability in Pennsylvania, coming to you from the Center for Media Innovation at Point Park University. Today, I have my great guest from Dollar Bank, Morton Stanfield. Morton, how are you today?
I'm great. Outstanding.
Outstanding.
Great to be with you today.
That's a super, energized response. I appreciate that. So, well, welcome to the Green Voice. We're glad to have you and Dollar Bank participating. It's good to get the financial insights into sustainability here in Pittsburgh. So, really excited to have you as a guest.
Yeah, excited to be here.
So tell me a little bit about yourself, your role in Dollar Bank in terms of community investing and some of those aspects. And let's learn a little bit about you first before we learn about the bank.
No problem. So I am Senior Vice President, Head of Community Development for the bank, and CRA Officer, Community Reinvestment Act Officer for the bank as well.
Can't wait to dive into that.
Yeah. So I oversee all of our community development efforts throughout our footprint. So Western Pennsylvania, Northeastern Ohio, Hampton Roads, Virginia, and a little piece of Maryland, Cumberland, Maryland.
A little piece of Maryland.
Yeah.
Okay. Is that like a historic acquisition? Or?
A recent merger with Standard Bank.
Okay. That's a new part of the footprint for me. What's been kind of your entry into the banking world? Let's start from the beginning a little bit.
So that's a good story. When I finished my bachelor's degree, my first job was as a freelance newspaper writer.
Okay.
So I did some articles for the Courier.
Oh.
So I actually started in journalism.
Okay.
And then I quickly realized I needed to make money. I did the math on how many articles I would have to do in a week.
Yeah.
So I started in really kind of an entry-level leadership development program at Dollar Bank.
Okay.
It was essentially a year-long program where at the end I became an assistant branch manager.
Okay.
Was promoted to branch manager a year later. Ran my own branch in Braddock Hills for 3 years.
Oh, nice.
Which was a great experience.
Okay.
To me, to be really good in banking, starting in the branches is essential. From there, I went to corporate lending. I spent 9 years in corporate lending, which is large small business and middle market C&I lending at Dollar Bank.
Commercial and industrial.
Correct.
Okay.
So that was a great experience. Had some really great clients, colleagues, really enjoyed that. But in that role, I did a lot of the bank's larger community development loans to nonprofits that were really impacting low to moderate income communities. So I made the transition to head of community development.
Okay, that's fascinating. What's it like getting started in the branches? Because that's where what I think most people obviously kind of, what banking resonates with them. That's their experience. You get to see all walks of life. It's a kind of a crossroads of folks. What's that experience like?
Well, what I like to say is starting in the branches, you learn the fundamentals of banking, which number one is customer service.
Yes.
And how to treat people with respect and dignity, regardless of how much money they have in your bank or how much money they're going to borrow.
Whether it's $1 million in the account or $100 in the account.
Absolutely. It's treating everybody as if they're the most important customer while you're with them. So I think starting with that founding principle really helped me in my career to then deal with anybody, whether it's in corporate lending or community development. It gave me that key principle of banking.
That's critical. Now, you mentioned CRA, and as we were talking before we got on the show, I actually got my start in the Community Reinvestment Act working for the Pittsburgh Community Reinvestment Group here in Pittsburgh, obviously. And it was an amazing experience for me, like working with the community and understanding, the insights and ins and outs of community development and finance. But the Community Reinvestment Act is really a critical piece of policy. Could you maybe share with listeners about what that is and what that means, not just both for communities, but also for the bank, because Dollar has a really amazing story to tell there in that regards.
We do. So the Community Reinvestment Act is legislation that was enacted in 1977, and really to combat redlining and other discriminatory lending practices, and to ensure that banks we're meeting the credit needs of the entire community, and especially low to moderate income communities. So fortunately, it comes from a history of discrimination before 1977, where banks would avoid lending into low income communities or
Intentionally,
communities of color. So the Community Reinvestment Act addresses that. At Dollar Bank, really lending to low and moderate income communities is in our DNA and part of who we are. And you may not know this, you may, but Dollar Bank was founded in 1855. We're actually the oldest bank in Pittsburgh. We're a mutual bank, which means we're essentially owned by our depositors. They're our shareholders. We don't have stock. And back in 1855, banking was essentially for the wealthy. You needed $50 to open an account, which was...
This is on 4th Avenue too, right?
4th Avenue.
Yep.
So banking was essentially just for the wealthy. You needed $50 to open an account, which in today's dollars is almost $2,000.
Wow.
And your average worker back then made 19 cents an hour.
Yeah.
So you can imagine the challenge of saving money to be able to participate in the banking system. So our founder, Charles Colton, said that, that's not right. Banking should be for everybody. And he started Dollar Bank, where you only needed $1 to open an account, which is why it's called Dollar Bank.
That's amazing. I never knew that.
Yeah. So that access to banking for low to moderate income people is literally the reason we were founded as a financial institution. So for us, the spirit of CRA is actually why we're here.
Wow, that's fascinating. Now, what's that trajectory been like for Dollar Bank? Because I know that we talked a little bit about where you've been and some of the other branches, but that presence starting out on 4th Avenue, what's the growth trajectory been for Dollar?
So we grew from a bank, where I think the first day deposits were under $100 to now we're an $11.5 billion financial institution.
That's a little bit of growth.
Yeah. And we're actually the largest mutual bank in the country. But that's been slow, consistent growth since 1855.
Wow.
Yeah.
And your footprint now, I know Pittsburgh, Cleveland, but then what are some of the others?
Yeah, so it's Western Pennsylvania.
Okay.
Northeastern Ohio, which is Cleveland and Akron. And then Hampton Roads, Virginia. So we're in Virginia Beach, Norfolk, Chesapeake, in that region. And then Western Maryland, which is Cumberland.
Has that growth been through acquisitions or organic or?
So that's been through acquisitions. We acquired a bank in Cleveland back in the 80s.
Okay.
We acquired a small bank in Hampton Roads about 7 years ago.
Okay.
And then we merged with Standard Bank
there in
back in 2019.
We have maybe a plug. We should note this for later on. We have at S&B, we have an office in Maryland, in Baltimore, actually Anne Arundel, and then also in Hampton Roads and Virginia Beach. Yeah, so we should talk afterwards. I'll connect you with our financial people, see if there's a there. So that's pretty interesting. So as we've progressed in that Community Reinvestment Act kind of era, I know from Pittsburgh's standpoint, a lot of the history, the law gets passed in 77. Fast forward, I know PCRG gets started in around 1987, 1988. And then you fast forward to today. I'd be interested to see, because I haven't been in the game for a while, but what that evolution has been like over the last 15 or 20 years in terms of the changing landscape and regulatory reform and what the impact is on Pittsburgh's communities.
Yeah, I think we're probably going through the most significant change now with CRA modernization, with a new rule that's been published, but now is in the courts going through litigation. So I think those are going to be the most significant changes that we may see. I think over the last decade, the Community Reinvestment Act has done its job. I think it's encouraged banks to lend in low to moderate income communities. We see more and more competition in those spaces. And for us, like I said earlier, it's part of who we are. It's in our DNA, and that's evidenced by the fact that we've had 12 consecutive outstanding CRA ratings, which is the highest rating you can achieve.
Congratulations.
Thank you. And those exams happen every 3 years. So that actually dates back to September 21st, 1992.
Wow.
So we've had the highest rating you can have under CRA since 1992.
Is it, in terms of like the needs of the community, have they changed, evolved? Are they the same?
I think a lot of the needs in the community remain the same. For us, our focus is really, number one, listening to communities and understanding that not every low to moderate income community has the same needs, right? And being intentional in each community and addressing what that need is specifically in that community.
Some communities might need a residential housing product. Others might need small business lending, vice versa.
Absolutely. Some communities may need an anchor business that's going to bring jobs, right? So it's understanding what those needs are. I think from a big picture standpoint, probably the most critical need right now is affordable housing and a lack of affordable housing. So that's kind of our number one focus and priority is on affordable housing with a focus on home ownership because we know how important home ownership is to building wealth.
Let's break that down a little bit because it is a hot topic today, and you hear a lot of it in the national media. I think I don't want to say the first time, but like it is prominent, right, in terms of the demand for affordable housing, the lack of supply of affordable housing. What's that look like in a place? I mean, you hear a lot of it, and I just listened to I won't plug another podcast, but I just listened to another podcast, and this was the topic about hyper-growth places like Las Vegas or some of the coastal communities, California, New York, New Jersey, places like that. What's it mean for Pittsburgh? Is it unique in any way, given that our population growth dynamics are a little bit different? That the spatial allocation of housing and things like, is it the same, just a different type of volume in terms of affordable housing, or what are some of the pinch points locally? I guess
I think the pinch points locally, and there's similarities between cities like Pittsburgh and Cleveland. And I think the pinch point is, you have an aging housing stock. That's very different than somewhere like Austin or Las Vegas,
where the stock is newer.
Yes.
Yeah.
In Pittsburgh, you have housing. A lot of it's deteriorating, needs improvements.
I like the term functionally obsolete.
Yeah. You have homeowners who are struggling to stay in their homes because of costly repairs, and what that means in terms of borrowing to make those repairs. And then a lot of that aging housing stock, kind of is either they're vacant, dilapidated. So you have the challenge of acquiring those properties, either fixing them up or tearing them down and doing new construction. So those are the challenges in terms of creating new inventory and retaining the existing affordable housing that's here. And it's really that aging housing stock. I think that's one of the bigger challenges.
That's huge. What about on like the homeowner side? I know that there's a huge drive. In fact, I remember, I think it was Dollar Bank had a program, Mortgages for Mothers.
Absolutely.
And innovative products that are being created for that first-time home buyer. What's that kind of two things with that? I'm curious. What's the engineering of a new product, and what are some of those needs for products for a first-time home buyer?
Yeah, so let's start with Mortgages for Mothers. That was a great plug. We actually, last year was the 25th anniversary of the program.
Really?
Yep. It's now called The Way Home.
Okay.
But we
goes to show how old I am. Thanks, I appreciate that, Morton.
No problem. But we actually hold our annual workshop every year, so that'll be coming up in March. And that leads into our first-time home buyers program, where we're the only bank in the region that actually does in-house credit counseling. So here in Pittsburgh, for example, we have
the only one.
The only one. The other banks do credit counseling.
I'm not surprised that Dollar Bank does. I'm just surprised that nobody else does it.
Yeah. Other banks use outside credit counselors, third parties, right. but we actually have bankers in-house who do the credit counseling, so it's more of a seamless transition. We kind of hold your hand through the entire process.
So you're getting them in early to educate them on the mortgage process, how they need to, effectively all the ducks they need to have in a row.
Yeah, and that starts with repairing your credit. So figuring out where you are from a credit standpoint. If you need credit repair, working with you to reduce debt, improve your credit score. That's creating a household budget so that when you do get the home, you can stay in it because now you know how to manage your money for any unexpected things that may pop up. And then it's understanding the home buying process, not just the mortgage, but the inspection, the appraisal.
Best dealing with $200 you could ever spend. It's probably
absolutely.
$400 now. Yeah. Inspection's critical.
It is. Dealing with a real estate agent, how to select a real estate agent, that entire process, which for a lot of people can be intimidating, especially if you're trying to be a first generation homeowner, and you don't have family members who have gone through the process who can help guide you. And a lot of people in our program, they are first generation homeowners. So
Are they? Yeah, I'm fascinated by this because I haven't talked about it for a while. But like, in that, what about finding a place? What's that selection determination look like? Do people, when they come into that program, do they already have an idea of where they want to be, or are they going through the program and starting to think about, okay?
I think it's a mixed bag. I think you have some people, they just know they want a house.
Yeah.
They don't know that much about all the neighborhoods in Pittsburgh. They know they want a house that they can afford. But we do have a lot of people too who come in and they want to live in a specific neighborhood. And that's where the challenges can be, depending on the inventory in that neighborhood, the quality of the housing stock. And going back to aging housing stock, and then the affordability. You have a lot of neighborhoods where people grew up, they rent there, and now they can't afford to own there.
Yep.
So it's kind of managing those expectations for the people in the program.
This isn't a corporate question. Do you think that people get stunted in that process right now? And what I mean by that is, that was what you laid out was exactly my personal experience. I rented in a neighborhood, and I couldn't afford to buy there. And that's what, I was like, well, I knew I needed a house. I knew I wanted a house. But then it started to get me to explore other places, which was good in the sense that you got to find more places in Pittsburgh that there's a lot of unique flavors in town, right? But it opens your eyes up to kind of new choices and availability. Are younger folks and first-time home buyers doing that, or are they really fixated on?
I think they're doing it.
Okay.
And it takes some encourement.
You're restoring hope for me. That's good.
It takes some encouragement. And it's just like you said, we try to encourage them, hey, check out these other communities. In Pittsburgh, that we like to talk about, people don't like to cross bridges.
Cross bridges and rivers.
Well, there are a lot of great neighborhoods in Pittsburgh. And I think people, if you're from the East End like me, you don't want to go to the North Side. But
you're like, oh.
Yeah, but there's some amazing communities in the North Side. There's amazing communities in the West End. So it's really just getting people to kind of step out of their comfort zone a little bit and give it a chance. And we've had plenty of people who ended up buying in a neighborhood they never thought they would buy in, and now they love it.
Is that a piece of the affordable housing question too, though? Like you mentioned, like the East End or some of the more popular, noteworthy places in the North Side, like the Mexican War Streets, or folks like that are living there that you go and you try a Spring Hill or a Westview or just to look out beyond your boundaries where you might find a house that's just like the one that you're looking for, but it's just in a different neighborhood. Is that a key piece of the equation too?
I think it's a key piece of the equation, but I also think long term, if we're talking about community development, we should have affordable options
across the continuum.
Yeah, exactly.
Yeah,
exactly. If I work in the East End, my job's in the East End, I shouldn't have to live 45 minutes.
That's true.
From where I work.
Because a big piece of the affordability question is also transportation costs, right?
Absolutely.
So if you can bundle that together. One of the things I would be interested in too, and this is where kind of my career starts to cross over a little bit, is like on the environmental side. And I'm interested to learn a little bit about how Dollar Bank, being an innovator, is seeing that the sustainability aspects of affordable housing, of lending and finance. What are some of the things that you guys are now starting to put, into your mindset, both in community development but also institution-wide, in terms of some of those opportunities that are being generated now, whether it's tax policy or lending products? Or...
Yeah. So I think I'd start with institution-wide. I think what we've tried to do is to really build relationships with major developers that have that sustainability as part of their core values. So 2 examples would be maybe our relationship with Walnut Capital and Burns and Scalo.
Yeah.
Both developers that we've had relationships with for over 30 years. And we've had the honor and the privilege to finance some of their major projects that really changed the game in terms of sustainability and urban projects in Pittsburgh. Bakery Square obviously being one of them.
What's that like for you all? Because when you're evolving when you're the bank, right? when say Walnut or Burns and Scalo come to you with a new project that it might look a little different from a conventional kind of development standpoint, but has these new attributes to it, whether that's rooftop solar or energy efficiency or things like that. Does that change the calculus at all, or have you all at the bank had to kind of educate yourself on like these new kind of attributes, I guess?
Well, I think if you're a good banker, you're always learning, right? So
Yeah.
I think as a financial institution, we've learned over time the benefits of those parts of projects and the long-term impact for the community, for the environment, and for the sustainability and the economic viability of the project.
Interesting.
So, and I think another part of that is that relationship that you have with the developer, where you have that trust and that comfort level that if this is an innovative idea we haven't seen before, we trust that you will execute it.
Interesting. Are you seeing a lot of customers come through with like purchase rehab types of desires or demands?
I think that is one of the biggest opportunities, especially in the community development space. And when you were talking earlier about creating new products, innovative products, I think that's where our focus needs to be.
Dive into that, because like why?
Well,
I
because
have my assumptions, but like I want to
because of our aging housing stock, that is probably one of the tools that hasn't really been used enough in community development. The housing's there. You need a loan that works for people, regular working people, to be able to buy that house, fix it up, and move in.
Talk a little bit of how that works, because I just threw out I realized I threw out a term that like I know, but maybe other folks don't. But
so essentially, it's if you're buying a home, let's use a neighborhood like Highland Park. There's a property that's maybe been vacant or needs significant improvements. You purchase the home with one loan product, one mortgage that covers the cost of acquisition of the property and all of the rehab to get the property to where you can move in.
So you can bundle it all together. Yeah. I think it's I think you're spot on, because like if you look at the volume of when I left the city, there was 26,000 vacant and abandoned properties across the city of Pittsburgh, and then you think about, we talked about it earlier, the encumbrances and legal red tape that you have to go through to get that property back to market. But you're right. Like if you have a purchase rehab product that allows you to upgrade the roof, install new windows, provide installation, big topic that we see now too is electrification of homes. You call up your friends at Burns and Scalo and you put some solar on the roof at the same time. Like there is billions of dollars worth of lending and investment that could happen just in a place like Pittsburgh.
Absolutely. And the products exist. I think we when I say we, the royal we, the industry, I don't think we really perfected it and found a way to do it efficiently and effectively where we can scale it to the degree that you're talking about.
You're right on. I mean, like you take some of the volume of housing and then, basically using a purchase rehab structure, but then have the ability to build like that supply chain alongside of it where you're putting in, split unit heat pumps. We had, Mike from Mitsubishi Electric here a couple months ago on talking about their split units that they can heat and cool. You think about like, the solar products and tax credits that are available, which I want to ask you about next. There is a bundling capability here that could be really significant, especially for a first-time home buyer, right? Because they could walk into that and not only are they getting a new home updated, but they can also reduce their utility costs, right? So like the cost of operation gets reduced, right?
And you're a first-time home buyer and you're moving into a very efficient, low-cost home.
Yeah.
So a lot of the low to moderate income first-time home buyers their budgets are very tight.
Yep.
So when you have fluctuations in energy costs and you're living in an older house that's not very efficient, that can be a challenge.
Huge.
So if I can address that going in, now I've taken a house that was vacant and not on the market and occupied. Now it's occupied and it's efficient. It's a win-win across the board.
I did a quick plug for the folks at Kia, the Keystone Energy Efficiency Alliance, and a friend of mine, Janine Zappa, works there. And Janine worked in the energy efficiency space, and she would always tell me, Grant, you got to get an energy audit. You got to get an energy audit. Finally, I convinced my wife to get the energy audit, and she freaked out. She's like, "Oh, this is going to be crazy." And what it does is it gives you, your cost of consumption, but then ultimately, what you need to do. And so it's like this punch list of how do you upgrade. And so that's what made my wife crazy. And of course, we go through the process. We save $300 a month in utility costs just from insulation and different types of sealing and some upgrading some things. And that's huge.
Yeah, that's what I need.
You get an energy audit, yeah. The home inspection and energy audit, the two plugs for whoever does that out there. You got to call those folks up. So, the other thing too that's been interesting, through the, the Biden administration recently, you've had a lot of investment in these sorts of climate solutions and climate technologies, and a lot of things in through the Inflation Reduction Act, some new tax credit programs and things like that are now available. How's the bank and community reinvestment in particular, how are you guys starting to think about some of those tools and tax credit programs and things like that? How does that factor in?
Yeah, I think it's going to provide a lot of opportunity for partnerships and financing, especially in the community investment space. And when we're talking about low to moderate income communities, the Greenhouse Gas Reduction Fund, which is a $27 billion program, as part of that, I think is going to be really impactful. You have funds that will flow to CDFIs, community development financial institutions, to lend money directly into low income communities for climate change and greenhouse gas reduction. And I think that presents opportunities for traditional financial institutions like Dollar Bank to partner with CDFIs on those projects. Typically, the way that will work is, CDFI may do a pre-development loan, and then a traditional financial institution like Dollar Bank will then come behind and do the primary financing, or maybe a CDFI does a loan behind a Dollar Bank for a project to close a gap.
Interesting.
So I think there's going to be a lot of opportunities when we talk about CRA for banks to get involved in low-income communities when it comes to sustainability.
Now, you're involved with the local CDFI, right?
Bridgeway Capital. Yes, I'm on the board at Bridgeway.
Talk to us a little bit about that structure. So how does that, or maybe the question is, when do you go to a CDFI versus going to a Dollar Bank in terms of a project structure? When do they come into the equation?
Yeah, so I think there's probably a lot of different examples, but I think when you have a project that's probably not considered bankable or borderline, traditional financial institutions are regulated by the federal government, so we have more constraints in terms of credit quality, collateral, years in business, all of those different factors. And with CDFIs, they're community mission driven and don't have those same regulations, so they're able to do financing that a traditional bank can't do.
Okay.
So when you have a business that's maybe closer to a startup phase or doing a project that's riskier, has more risk, that's when a CDFI becomes a great option.
Interesting. Paint me a picture of an example. Let's play with this a little bit. What's an example of when the CDFI comes in? I'm going to give you some criteria here.
Okay.
You got a traditional lender like Dollar, you got a CDFI like Bridgeway, and you want somebody's trying to build or either build new or rehab a structure, and they want to use some of these new IRA tax credits. You mentioned the Greenhouse Gas Reduction Fund. How's the developer or the project owner going to come into that project? Like they want to make something sustainable. They want to put solar and energy, make it energy efficient. How do they work with a lender like Bridgeway and Dollar to kind of make that happen?
Absolutely. So, maybe the project needs pre-development money that developer doesn't have to get that project done in a low-income community.
So like an engineering, construction, or design, or
all of those things.
Okay.
So a Bridgeway Capital can come in and do a pre-development loan to cover those costs, and then you could have a dollar bank come in and do the first mortgage for the project.
Okay.
And partnering together, you make a project happen that otherwise wouldn't have gotten off the ground.
So I might have $100,000 in pre-development costs to pay my engineer and my architect to come up with this great sustainable structure, and then they tell me their grant, well, that's going to cost you $1 million to build this great sustainable structure. Then I'm talking to Dollar, and I come to you and say, hey, Morton, I need $1 million, and I got this $100,000 pre-development loan. Then you bundle it all together.
Absolutely. Another example could be
that easy.
Yeah, well, nothing's ever that easy.
Never that easy. But we only have a couple minutes, so we got to,
But another example might be a similar project. The pre-development's covered. It's $1 million, and based on the risk profile, whether that's the resources of the developer who's doing the project, the appraisal of the property, say it's a special single-purpose property, and the bank may not be comfortable going to, say, an 80% loan to value. So say that from a risk standpoint, the bank says, we can do this based on credit profile at 70% loan to value. And the developer doesn't have the 30%, or the business that's doing the project doesn't have the 30% to do the rest of the loan. Bridgeway could then come in, a CDFI like Bridgeway could come in and close that 30% gap.
Got it.
And say do 20% up to 90% with the borrower putting 10% equity.
Okay.
So there's opportunities like that. The other side of it is CDFIs like Bridgeway doing the deals on their own, lending directly to small businesses that are working
to take the whole project.
Yeah, or working in that sustainability space.
Okay.
And I think that's going to be a critical part of those funds flowing in through the Reduction Act, is Bridgeway helping, and CDFIs like Bridgeway helping small businesses in low income and minority communities.
That's huge, because then they can help, I'm going to say, like managing the credits, for example, whether it's like the Greenhouse Gas Reduction Fund, or we were talking, in show prep too about like the direct pay provisions, which is a tax credit available to nonprofits and municipalities. So somebody like Bridgeway can help you structure that effectively from a lending standpoint.
Absolutely. And then, the way it really should work is if you have small businesses, many of them minority-owned small businesses that have only been in business for a few years, want to work in this space, whether that's installing solar or anything in that space, Bridgeway and other CDFIs can be that initial lender that lends to them before they're eligible for bank financing. And then over time, as that business grows and their capacity grows, then they can go to a traditional bank, get traditional financing, and continue to grow.
To do the next one and the next one.
And then that cycle continues. And that's how you have long-term economic impact for historically disadvantaged small businesses.
I don't think, maybe it's me, but like people are talking about this enough. Like what you just touched upon is so much of a game changer in terms of not just doing the project, but think about the workforce development capabilities, the supply chain businesses that go along that. Like this is like massive catalytic investment that could, when you cross over like the environmental side with the community development side, it's like 1 + 1 = 3. Like this is
it's a great opportunity to really take that federal money and leverage private investment, leverage financing from banks. But it's up to all of us to execute it.
That's right.
The funds are there, but that we know historically that's not enough. We have to effectively and efficiently execute that strategy and leverage those funds and make it happen.
Are there conversations that are being had right now that are are that you're a part of? I'm just curious, like where you're at the table and the developers at the table and the environmental sides at the table and the workforce. Is everybody?
I think all those conversations happen and are going to be happening more.
Yeah.
As the funds flow into the communities.
So it's everybody's kind of waiting to see how it takes shape.
Yeah, exactly.
Yeah, that's interesting. Just to pivot here towards the home stretch, a couple of things I wanted to ask you too is you are a man about the community, involved in a number of different kind of initiatives, not just Bridgeway Capital, but you're also on the board of the zoo.
I am. I'm the vice chairman of the board of the zoo.
And did I also see that you were just awarded at Hello Neighbor? Is that correct?
Yes. So Dollar Bank.
I may or may not have been in the audience.
Oh,
so,
you were there.
I was there.
Okay. So we won. Dollar Bank was honored with the Good Neighbor Award.
Awesome.
Which was really exciting. Our relationship with Hello Neighbor goes back to when they first started. We've been supporting them not just through contributions or grants, but through a partnership that helps the refugees in their program open bank accounts, which can be a real challenge when you're coming from maybe a war-torn country with your family. You have nothing, and you need to get a job. You need to get into the financial industry, get into a financial institution, get a bank account so you can get a job. And then there's roadblocks to that. So we've been able to really work with them, provide that financial education to their clients, and then open their first bank account and start their journey.
That's an amazing story. I mean, it's fascinating for me. As my friends know, I'm a big believer in the 6 degrees of separation. So anytime that I get like these overlaps between a show with the zoo and those folks, and I'm at the Hello Neighbor event and Bridgeway Capital, like I just love all that. One big last question, I guess, what's on the horizon for you and for Dollar Bank in terms of some of these things that we talked about? Where do you see, kind of innovation occurring or some of the next things over the next 6 to 12 months where you and the Community Reinvestment Program, but also Dollar are really pivoting towards?
Yeah, I think it's some of the things we talked about in terms of looking at how do we make sure that we're not just doing what we've always done, but creating products and services that address specific needs today. So when we talk about aging housing stock and the need for low to moderate income people to be able to make improvements to their homes if they're existing homeowners, the need for low to moderate income first-time home buyers to be able to buy and rehab a home in the community they grew up in. And I think that's really about taking a look at our existing products and seeing what do we need to tweak, or maybe what new product do we need to create to help address those specific needs. And that comes down to listening to the needs of each community and making sure that we're meeting people where they are.
That's amazing. Morton, thank you so much for the work that you do, and thanks for being a guest here on the Green Voice podcast.
No, thanks for having me. This was great. I really enjoyed it.
Well, we'll have you back in a couple months just to see how things are going and progressing, because I know you'll have more good news for us.
Sounds good to me.
All right. Thanks so much. And thank you all for listening in to the Green Voice. Thank you to my man Wayne on the controls here, and thanks to the team at Pittsburgh Earth Day for bringing this great show to you all. Thanks for listening in. I'm Grant Ervin from S&B USA. And we'll see you next episode.